It's a pleasure to welcome you to this year's edition of the Swiss Value Day. My name is Urban Müller, and I'm responsible for client relations at BWM. I'm very happy to co-host today's event with Alex Rauchenstein. He's managing partner at SIA. And I think we've got a very exciting program for you here today. In the first part, up until the break, we cover mostly top-down aspects, market environment, and then after the break, we'll dig into a few companies, investment cases, which we present with the idea of showing you, for the three firms who are present here today, how we invest, how we approach investing. We're extremely fortunate to have some fantastic guests again this year who strengthen our program. From Canada, we've got Kim Shannon, who has got an amazing amount of experience in investing. She set up her own investment firm, Sionna Investment Managers, in 2002 and built it up to be one of the most successful and leading investment management firms in Canada. And it's a real pleasure to have her here today. We also have Edward Chancellor, who is both a very accomplished author and journalist and a successful investor, having been at the asset allocation team of GMO. And he'll grace us with his historic perspective on markets. Thank you, Edward. And we're also very grateful for having Mark Ditley here today. Mark is the founder of The Market. He is a very accomplished journalist, but himself, who will provide extremely good guidance to our guests and speakers at the fireside chat on value investing. Thank you, Mark. Let me say a few words about our firm, BWM. We're very focused on generating good long-term return for our clients, focused on value investing. Our approach is straightforward in that we have a structured investment process that ends up in a concentrated portfolio of 25 to 30 stocks. And when Marcus later presents our investment case, hopefully you'll get a better idea how we go about building our portfolios. We're also focused in that our organization is intended to allow us to fully concentrate on investing. We've been set up in 1997. We're organized as a partnership. There are 6 of us. We've got Georg von Wyss. He's our portfolio manager and analyst. I already mentioned Marcus Kausen. He's an analyst. We've got our other colleagues as well. Lars Celsas and Pascal Prus, they're here. Pascal is back there. And our chief operating officer is Daniel Jordan. For us, the organizational structure is important in terms of alignment. Also, the way we allocate our money is effectively to our own funds to allow us to really be aligned with our clients. We're focused in that we basically offer only one investment strategy. It's offered in 2 funds. One is the classic global equity fund, which is an all-cap strategy, and the other one is the classic value equity fund, which is focused on mid and large caps. And with that, Alex, the word is yours.
Thanks a lot, Urban. Just if you want to have a closer look at the slides, you could actually take a picture of the QR code or go with it on the camera, and then you can follow all the slides. But don't worry, you get spammed by us after the presentation because if we really want you make money with us, that's the main purpose of this setup. I'm extremely pleased to be here now today because 6 years ago, I really had the idea, why don't we create a Swiss Value Day? Because value investing became obsolete. And I really thought, okay, we have to bang on the table. And then I asked George to visit me in Lachen, to have a nice lunch at the lake, and say, why don't we do it together? We are competitors, but why don't we team up? And then 2 years ago, I met Kim in Vienna at the Value Conference. You know, Kim had at her peak, I think, 10 billion Canadian. You know how large she still is? 1.8 or 1.5. Division by 10. But that's basically a phenomenon of the industry. Now, I have to speed up because we have a lot of stuff to discuss, but unfortunately I still have to cover one subject. I don't want to discuss because I have no idea. Nevertheless, I'm still an intelligence officer of the Swiss Army. I have no clue what's going on. I think not even the US president has a clue, and I think he's not the one deciding at the end, because you really see asymmetric warfare at work. But markets are too relaxed. And in our fund, as you know, we have two funds, a net resources equity fund where we have currently 43% in energy. And we increased that in mid-February, thanks to Marcos. And we reduced copper on the other hand. And on our value fund, we have 10%. But there is still a scenario where it could become nasty, in the sense that we'll go to a full-fledged energy crisis. I hope not, because I plan to do family holidays in October in Japan. And I still hope that there is some kerosene left. And Kim was checking if she can fly back to Canada, she told me. Now, we're gonna have a fantastic gentleman with the first name Ed, talking about GMO and charts like that. And I found out that I took actually a similar chart that he will show you later on, so I will be fast on this one. But I think it's very important what's going on in the market. You see here how much of market cap today trades not on a PE, on a PS, price to sales above 10. It's 34%. In 2000, it stopped going up at 30%. Now, tomorrow we have this small IPO. This small IPO comes to the market with a price sales of 100. I was reading Mark Dietlich's report last Friday. It's fascinating. How can that be? And on the bottom right, you see that our price sales of the fund is 1.19. I think you can really offer something else. We have an active share, which is a deviation from MSCI World of 97% in our fund. And we were able to beat this MSCI World over the last 6 years doing so with only 15% US weightings. Now, the next chart is also from GMO, and I like it a lot because it shows in a scatter plot risk return, and GMO is old enough to do that since 40 years. And you see US large caps in their perceptions, and they are as bad as we are in market timing. So don't take that as an advice to sell tomorrow, but maybe it's good to do it really, because we have something else going on tomorrow. But it's amazing. They expect a negative return of 3 to 4% for US large caps. And on the other hand, international small and mid caps, you can actually get 6 to 7% plus. So we fish in the pond above, and maybe you really challenge your idea if you just want to be invested in the MSCI World. Because why? There's a big game changer, which is these large tech companies that were massively profitable in the past because of asset light are now moving to asset heavy. Ask yourself over how many years they depreciate their data centers. 30 years? 5 years? Now, to wake you up, ladies and gentlemen, I want to do some math with you, but very simple one. And the result of that should be that everybody can go home and calculate his own expectation of the 10 years US stock returns. Because there is a magic formula, very simple. It's too simple for Marcos, he says, because he likes more complex stuff, but I'm a simple guy, so for me it's good. It starts with a dividend yield, you add earnings growth, and you add the change in PE. Now, a nice gentleman called Professor Javier Estrada from IESE Barcelona did some studies and published that, and he came up that on average the long-term yields, the dividend yields since the last 150 years were 4%, earnings growth 4.2%, and the average PE over this time period in the US market was 16. He also did in this study, because that was just averaging the last years, he actually did a calculation. And he had a very interesting result. He found out that the EPS growth over 10 years relative to the multiple change are negatively correlated, which is pretty surprising. Not so if you're a value guy, because it means when you have fast growth, realized fast growth, not hope of fast growth, realized fast growth, then you have a P contraction and vice versa. So to end up all this calculation that I was boring you now, I started with today's dividend yield, which is 1.06, so I rounded up to 1.1. I added the average 150-year earnings growth of 4.2, and I simply said, why don't we go back to 16 times in the US market from 27, and then you have to deduct 5%, and you basically get the zero over the next 10 years. You can play yourself. You can assume that the P goes to 35. You can assume that it grows 15% every year, like it is expected by the analysts this year for the US market, etc., etc. That's now time for me to pass on to my managing partner and CIO Marcos Hernandez. Thanks a lot. The Q&A, by the way, will take after the fireside chat and then after the specific companies.
Thank you, Alex. Good morning, everybody. Thanks for joining this morning. This is the 5th year we present here on the Value Day, on the Swiss Value Day. And basically, I have around 20 minutes. I have prepared a presentation which is going to be a bit different. It's going to talk about value emotions, about the relation of market psychology and value, and try to explain why value in general terms is seen as so negative. Basically, you know, I decided to title the presentation not the cool kids, because the value guys, we are not seen as the cool kids, always with problems here and there with the stocks that are falling, with bad news. And I wanted to just dig into this a little bit. So value investing is a pain in the neck. Let's go back to work. Let's go to work. So what is value? Let's go to the basic, and value is, the value guys, we are looking for stocks that are cheap. For me, in my opinion, this is the starting point. You are looking for businesses that are cheap, and you want to buy them at a cheap price. But if businesses are cheap in the stock market, this means that there are issues, that there is no momentum. Something is going on that is wrong, because otherwise they would move up, everybody happy, everybody buying. So there's something that is going wrong. So if there are issues, there is risk perception. And as we are kind of psychological, entangled people, we are a crowd, and we follow this perception, and we are not attracted by these stocks, these portfolios of value stocks, and this philosophy. So our philosophy is very contrarian. Very contrarian. We go against the crowd. We go against everybody. Sometimes you wouldn't believe it, but you go against everybody around you, because you need to stick about your idea here and there, and it's very complicated. Sometimes it gets very rough, and it gets very rough when you have a kind of stock going down 5% every day. And then value is difficult to sell, because I come here and I try to sell my fund because we want to grow, we want to reach 1 billion, we are far from that. And how do we sell this? So I'm going to try to explain why it is difficult to sell, why we are so kind of seen as not the cool guys. So there's no narrative in our fund. In our value fund, we run 2 funds at SIA, natural resources and global value. It's much easier to sell the global resources, because the natural resources, because there is a story, and I can talk about copper and copper demand and supply and oil and energy. In the value space, we are value guys. We've been underperforming for like 15 years versus growth and versus the index, which means that really there's not really a narrative. Then you see the index guys and the passive guys and the thematic guys selling growth, selling AI, selling robots. I mean, every narrative is fantastic and it's very attractive. And in value, we sell balance sheets, we sell downside protection, we sell recovery. So really, let's sum it up and cut it here. There's no really big narrative in our value fund. We also ask you, as investors or potential investors, something which is emotionally very tough. What we buy is hated. It is really unpopular. You get very nasty questions that, by the way, I'm going to get them when I present in Pandora. I've had a hint. And this, you know, you're not in the fashion moment, you're not in the press, and it's really going against the, now more because we have social media, which everything is concentrating the ideas towards the same thing. Everybody will buy SpaceX. I'm not going to enter there because I would stay a long time, but you know, I think it is very emotionally tough to buy value. So I have added some quotes. Sorry. I cannot go back?
Yes, you can, with the small one.
With the small one, sorry. Okay, and finally, patience. So normally when we try to welcome investors to our funds, normally, you know, we don't know the timing. The stocks are not moving up or the fund is not performing well in the short term. And it is normal because normally when you buy cheap, you still have the, you know, bad news, still things are going wrong. So, you know, in my experience, and it's almost 30 years, basically I have no idea on the timing. We have had stocks that in 1 month were reacting. We have stocks like, you know, year after year is like, and then one day or 1 year they move up 60%, like last year with ISS that I will show up. And then you look really wrong. And what is worse, a bit idiot, because you're saying things against everybody and you're wrong in the short term. So patience, narrative, and emotions are something that is difficult to manage. And I would quote Benjamin Graham here. I think this is one of the, you know, best sentences ever in the value space or in the investing space. In the short run, the market is a voting machine, but in the long run, it's a weighting machine. So if your numbers and your strategic analysis is good, you will do good money in the long term. So conclusion, very fast. We normally underperform when everybody is super bullish. We look old-fashioned. Even Warren Buffett, remember in 2000, Warren Buffett was, you know, really set apart like this guy is too old, he doesn't understand the new technologies. Warren Buffett. So this happens to almost everybody. We need to explain a lot of technicalities in order to defend your investment case, where going out there and talking about the SpaceX is super easy because everybody is open to these new Mars colonies. We are different, portfolios are different, and you need to just believe us and stay for the long term, so this demands patience. So just to finish this part of emotions and value investing as a contrarian philosophy, you know, this requires temperament. So not everybody can do this. Not everybody can go against the crowd and all your entourage in moments where there is a lot of stress, like in 2020 in the COVID, that you need to really be very strong, very convinced of what you do. You need to know the stocks. You need to know everything very, very insightful in order to resist. So I'm going to go against my own fund, which is the LTIF Classic, Long-Term Investment Fund Classic, and I'm going to show you the momentum we have. So this is the top 10. It's more or less 42, normally 40 to 50% of the fund. So as BWM, we are very concentrated, and this is the top 10. And I'm not going to comment in detail. In the right-hand side of the slide, you will see some positives and some negatives, but I'm not going to go deep. I just want to show the momentum. Plaxi, one of the worldwide leaders in digital meal vouchers, down 60% 2 years. Leroy Seafood, a big company, salmon farming in Norway, down 48% in 4 years. Pandora, I will dig deeper later on in the investment case, down 60%. This is the jewelry firm, down 60%, 2025. So this is 1 year. Reckitt Benckiser, you know them well, consumer, pharma OTC, down 40% in 6 years. Grifols, we have presented here in a couple of value days the company. It's a plasma protein company, down 73% since 2020. Sodexo, global leader, maybe not the #1, Compass Group, but this is a good leader, worldwide leader, down 50%. ISS, the cleaning company, I think Alex presented here a couple of years ago, is now rebounded, but at some point year ago, it was down 56%. And Viscofan, the sausage casing company, we are in and out here for ages, and we were in Devro down 25% because some news in the US were really mishandled. So how can I sell this fund to anybody? I mean, people look at it and they say, that is impossible to sell. So what did the fund last year? So it's full of falling knives. And every time we present, there's a lot of nasty questions that come. So this is business as usual because everybody's negative, so they want to challenge you. Do you know this? Do you know that? You know what happens, that in the last 15 years, our average year return is almost 11% with this, falling knives. I was a young manager in London, surrounded by the trading guys that were approaching me saying, never buy a falling knife. Never buy a falling knife. And then the cemetery is full of average down guys. And it's the only thing I was doing. Do you look at the chart? Have you looked at the chart? You know, we buy cheap. And this is the result of buying cheap. And then for those who question us when we say that the value cycle has started, so there's some ups and downs, and now it is true that the Max 7 and AI is back a little bit for the last few months with all these IPOs. Basically, we are beating the index for the last, I think it is 6 years, 5 or 6 years. So we are getting there, value is getting there. And you will see in the presentations of my colleagues here that looks like we have entered, but we are going to accelerate in a value cycle. And is what also Alex was hinting. Let me go fast on how we resist all this pessimism and how we are able to really present a fund where half of the fund is down a lot, at least in a momentum perspective. So our strategy has evolved towards strategic value. I'm going to simplify. It is Warren Buffett after Charlie Munger. So we move from deep value to more quality value. We do something different, which is a strategic analysis that we learned from our founder, Carlos Jarillo. And this gives us the strength because we know, or at least our analysis says this business is a very good business and it will overcome the problems. And we know the portfolio. I would like to ask the same questions people ask me to SpaceX. So what is the profit you're going to make in Mars? What is the profit you're going to make in AI? So this can be challenged relatively easy. Long-term partnership, these are two words that are very, very strong. We don't focus on the next quarter. Actually, when we see companies and we talk to the management, we say, we are not interested in this year's results, and they're like, ooh. So you're 1 out of 100 because everybody is focused on next quarter, then 6 months, and then the year upgrades, downgrades. It is true, upgrades and downgrades are the main driver of the stock price short term. But we average down. And we like a lot the definition of Keynes of investing. He splits in two. I've repeated that many times. Capital protection and decent returns. This is very important. We don't want to make 20%. We want to make 10 to 12 net, and then control the risk. We don't want to make, we could build a portfolio of 20%, it's too risky, in my opinion. So we take the risk management very seriously, and a way to explain this complicated chart is more parallelism with the funds, with the bonds market. Basically, bonds are qualified as investment grade, non-investment grade, and then you have AAA, AA, B, BBB, blah, blah. We're doing the same with equities. So we qualify, or we give a rating of risk to every stock. So a bunch of Nestlé's, Unilever's, Coca-Cola's, massive franchises would be category 1, low risk. We cannot ask at 20% to buy Nestlé. Even now Nestlé, that is in trouble, is not giving 20%. It's giving you 12, 13%, which is a very good return for Nestlé, by the way. So we could buy Nestlé now. And we start from there, and then we increase the risk, and we increase the return. And this helps us to balance. And look, it works. In 2020, when we had the market falling 30%, we rebalanced the portfolio. We had 2/3 in 1 and 2s. They fell less. And when the market collapsed at 30%, we reversed the portfolio. We bought 3 and 4s that were falling like 60%. This is why we did very well after that. I'm going to accelerate. Risk and return, we are obsessed by numbers. We do a DCF, we have IRRs, we have also IVs. And don't forget, Warren Buffett tells you, and Charlie and Ben, that you need to have a price objective. If you don't value a company, how do you invest in the company? You need to more or less understand what is the intrinsic value, and we do that. So we can give you what is the intrinsic value of the fund, and we give it, and we've given that for many, many years, so we'll let enter on. And we assign the risk categories that we committed. We assign ESG categories because this ESG analysis helps us to understand if the management is good and you can trust them. And basically, the IRR of the fund now is high. I will enter now. And final thing that differentiates us, and this is also learning from the value school, is that we have a watch list. We only follow 300 stocks. We don't think we can follow much more. We don't try to understand the SpaceX and the likes. And we have a sector matrix where we like this with this sector, we don't like this one. So this gives you where you can, focus your observation and your screenings. And this is the classic. In 2020, we decided, Alex and me, to give guidance, not because we want to be accurate on the guidance. So the orange line is the guidance for 10 years. The objective was saying, hey guys, we commit on 10%. We are doing 10% for 50 years, and this is what should happen. And then we were saying, this is going to do like this. So some years above, some years below. Strangely, as the market has been more or less calm, we've been almost right on the spot. So the blue line is the real net asset value of the fund. What is surprising now is that we have a very high IRR. The IRR of the fund is now 17 before fees and expenses, roughly 15%. We should do 15% in the next, in the long term, in the midterm, which is surprising because the market is expensive. I mean, we have seen that the market is expensive and the index is expensive. Okay, if you take out the big caps and you do the unweighted thing, it's not that expensive. And we find a lot of pockets of value. I think the three of us find very interesting sectors, very interesting names that are not in the news that will or should make this. I really doubt I can make 15% in my experience, top my years in value, long term. I'm always talking 15, 20 years. First, those that couldn't stay are out, first. And those that stay, you would be surprised. The average is 7, 8 to 12, 13. You don't find people 15 years, 15%. It's the risk, the risk raises, and then sometimes, boom, you're wrong. Sorry. And the flight to quality we have done some from deep value to quality value has brought this unexpected asset, although we like it, which is a lower beta. So beta of the fund now is 0.7, so our target is, we don't care about this. What we care is not to fall more than the market when the market falls, because this is very important to take care of our investors that don't suffer, over-suffer when there is a drawdown in the market. And then, as I know that you guys are going to test us in II, I said, okay, I'm going to test myself before people test the fund. So I asked AI on SIA, on our fund, description, okay, deep value, black, conviction, concentration, and then out of favor. And then I was like pissed off a little bit, but then exposure, consumer, black, weights, US, Spain, Denmark, top holdings, ISS, Grifols. Interesting when value works and uncomfortable when the market is rewarding something else. So, again, AI is kind of, it's not bad. And then the same with the rank. So I said to classify ourselves, it says we are good, but then concentration, fees, unhedged FX, and drawdowns make it harder to hold through the full cycle, and this is fully wrong. So this is exactly what makes us an investment, which in our opinion is very interesting. And then I check a little bit our future, which matches a little bit with what we want to do. So we don't want to really do much more than what we have. We have an investment committee which is very experienced with 4 people. We run 400 million, so we are small. But if we do our 10%, and this is the happy news, we should be around 800 million in 6 years, 7 years. I will be a little bit older, but 800 million, you start to be a little bit like approaching the league. And then looking at 2039, now you know what happens to me well, it's a bit late because I remember when you read The Snowball, you realize that Warren Buffett realized the compounded effect of money when he was 15 or say 16. And I realized it like 30 years later, but better late than never. When you compound, you know, in 13 years, we should be in 1.6 billion. This is what keeps us alive. We don't want to compete with the 300 trillion Blackstones of this world. So maybe we are not the cool ones, but when we look at our pensions, I can tell you that it's surprising. You look at the net asset value and this compounding thing, even ourselves, we get surprised. So I'm going to finish 1 second here saying that the whole presentation was a little bit wrong. If you look at persons, if you want to be very basic, we have 3 axes: quantitative, qualitative, and spiritual. Then you may go deeper there, but quantitatively, value investing, we do our numbers. The performance is good. If you take the value managers 8 to 12, it's a very good performance. I think from a quantitative perspective, numbers look good for the value investing. And if you look to value against growth long term, I think somebody will present the chart, value beats growth. So from the quantitative, we are cool. From the qualitative, most of value guys are humble. We buy on the cheap, we look for issues. We are not extremely selling people that selling, you know, the fashionable things. So in terms of qualitative, the work which is behind how we know the sectors, how we know the names, I think there is much more knowledge in the value space than, at least in passive, but even in some other parts of the market. So I would say that from a qualitative, it's also cool. And then from spirit, you know, we normally are people that in the end, most of the big guys, the big value managers have been looking for philanthropy as the end of their career or you know, at least sharing profits with charity. So the spirit of value, in my opinion, it's a style, it's a lifestyle. So nothing bad, nothing good to be in this and that, but it's a good way to understand things. So the conclusion is, yes, we are the cool kids. People say, you're not the cool kids. We are the cool kids. Thank you. Georg.
Thank you, Marcos. Normally, I'm a little jealous of what Marcos just did because he got to talk about stocks, and most of what we do, most of our days are spent thinking about companies, analyzing companies at BWM too. But maybe it's to your advantage that I'm not going to do it because I'd repeat a lot of the things that Marcos said about value investing in general. What I'm going to do is I'm going to focus on a high-level topic, and the reason is my colleague Urban Müller, who you've already met in the beginning, did some research which was so interesting that for all of us here who are interested in value investing, the conclusions are something you'll want to hear, and if you're not interested in value investing, there are conclusions that you should hear. So, as you know, maybe you don't know, our long-term track record is good. We've been hitting new highs here, the Classic Global Equity Fund, which has been in business since 1997, and we've had a wonderful run since the end of 2024. Things are finally working. So the question is, can it last? And thanks to Urban's research, we're more than convinced that it can last. Now, what he did was he took the Fama and French data and looked at it in a new way. As you know, Fama French had a data set for their seminal 1992 paper, which is available online and has been updated monthly since then. And one of the things you can do with it is you can sort it into 5 categories. If you take the US data by the cheapest, that would be the ones in green, so that's the cheapest 20% of stocks, up to the most 20% of stocks, so they're the most expensive. They're hot, that's why I colored them red. In Europe, the data set goes back to about 1990. Here, Fama and French split it into thirds, and all of the sorts are based on either price cash flow, price book, or price earnings. So you've got valuation criteria that differentiate these groups. And it doesn't really matter which one you take. The conclusion turns out to be the same. So what did we do? Urban asked 2 questions. How does the market cap, so the weight of each of these 5 quintiles or 3/3, how does that move over time? Is there any pattern that we can recognize, any rule to it? And then the second question is, do these weights at any particular point in time, so let's say that they're high as they are today, does that tell us anything about the future? Well, here's the US quintile, the 2 quintiles from the US, the most expensive one in red, as a percentage of market cap. So those 20% of stocks now account for over 60% of the market cap in the US. And then the cheapest quintile, which is the area where we fish. And as you can see, there's clearly a pattern here. Mean reversion is at work. We have peaks, we have valleys, as you would expect. And right now we're at a high point, and you would expect that at some point that's going to come down. What does that mean in terms of future performance? Oh, and here's Europe as well. Because we're sorting the world into thirds, the difference isn't that big, and also we started in 1990, so the most expensive third is better. It's stronger right now in terms of market cap, but it's not as an egregious situation as in the United States. Okay, so let's look at this second question. What happens at each particular point? And the way I'm going to show you is I'm going to take the market shares of the most expensive quintile, and I will show you what the future performance was at each point in time. And I'm going to put these bubbles on top of each point in time. So we'll look 3 years ahead and say, from that point on, how did we do 3 years later or 5 years later? And if the bubble is solid colored, value outperformed growth. And if the bubble is white, as the one on the bottom right is, then growth outperformed value. And the size of the bubble says by how much. And here's what the data looks like if we look 5 years ahead at each point. So you see on the far right, 5 years haven't passed, so we don't know how it's going to turn out yet. That's why we're here, to talk about this. But history shows us that there's a clear pattern. When market concentration was high in growth stocks, performance of value in the following 5 years was very good. The pattern holds for 3-year data. That's what I show you here. It's a little less evident. And we could still say that when growth stocks are a huge part of the market, that they outperform going forward. For the other points, when market concentration isn't as high, it's not as easy to tell. Sometimes value outperforms, sometimes growth outperforms. But growth never, or almost, except in the 1920s, it never outperformed when we hit peaks, really, really high levels of concentration as we have today. And that's an important conclusion given where we are today, which is at a very high level. Let's look at it in absolute terms. Here I'm showing you the data just for the times when value outperformed, just for when value outperformed. And in green, you see the absolute return of value. And you see that there aren't very many episodes where value lost you money. Yes, in the 20s it happened, and there in the 70s, a couple of months. But most of the time, value made you money in absolute terms. Growth, however, over these periods did lose you money at some point. So the relative outperformance isn't just that value went up more, that happened too, but you actually lost money if you were invested in the most expensive stocks. Let me put some numbers around that. So what we're going to do is we're going to take this line and sort it into 5 buckets. The B1 bucket, so the lowest bucket, is all the observations where concentration was lowest. The B5 bucket is all the observations where concentration was highest. I'm just sorting it evenly. That's what those 4 lines show, that I've sorted each period into one, well, Orban sorted each period into one of these 5 buckets. And I'm going to show you the performance statistics now. So these are the relative performance statistics. The US, solid colored, Europe with the diagonal lines. And you see, when we had low growth concentration, so when we were sort of lower on that red line, value is better, but sometimes it's better, sometimes it's not. There's not a clear pattern here, I would say. But when it when we get to higher concentration, clearly you see that value starts to outperform very strongly. And we are in a time of high concentration. Here are the absolute returns. Value makes you money all the time. That's good. But as we saw before, so does growth under certain circumstances, not where we are today. So now here the shameless plug for our own product. The classic funds are a value fund, so we're giving you cheap stocks. Price to book is about a third of the market. Those first three lines are based on consensus numbers. PE, dividend is also about 60% of the market, and the dividend yield is more than twice the market, not because we look for dividends, they're tax inefficient, so we don't really like them, but we'll take them if a company has high cash flows and a good balance sheet, it is able to pay dividends. And so this is an indication that we have a portfolio of companies that on the whole is well financed and generates cash flows. On the bottom line, you'll see our estimate of the price to intrinsic value. As Marcos Hernandez, my colleague, will show you after the coffee break, we estimate an intrinsic value for every share, and we try to buy at a discount to that intrinsic value. And right now, on average, you're buying $1 or a franc's worth of value for 61 or 66 at Oppen, which on a historical basis is pretty cheap. So to sum up, value's performance should last because we do have an excessive concentration in growth stocks, and so the conditions for value outperformance are excellent, for value absolute performance are excellent, and therefore we think that value belongs in every portfolio all the time, but especially now. It's the only prudent thing to do. And now I'm going to ask Kim to come up, who's going to give you a similar talk going at this question over time from a slightly different angle, which fits beautifully with what I just said. Thanks.
Great. Thank you, George. I agree with George. Our presentations will be fairly aligned. I'm calling this overall presentation, Do You Have Enough Inflation Protection? And that's because not many people are investing in value. And I really want to highlight a quote from a well-regarded financial historian, Russell Napier from Ireland. And he wrote the book called An Anatomy of the Bear Market. So he really understands, the historical bull and bear markets, and he gives a lot of examples of what the media was saying in advance and post the peak, and how there's so many mixed messages in the media at the time. You'll get the growth people talking and the value people talking, and it's hard as an observer to see the truth while you're in the middle of it. And he highlights in particular a stagflationary period, 65 to 82. And he says that the only asset class that preserved wealth for investors was value investing. And I found that a very compelling statement to lead off my presentation overall. So first of all, I want to highlight, and we've talked a little bit about this earlier today, is how lonely value managers feel today. And this event today has been just so delightful to myself because there's been so much talk about value in a very positive way. These are true believers standing up here on the stage. But most investment events today are very growth oriented, and that's very very typical. Human beings want to win the game of investing. And when I was drawn into investing earlier in my career, I was really drawn to the fact that investing isn't just about fundamentals. Yes, in the long run, stocks will migrate to their fundamental value. But we waver from it a lot. And why we waver from it is human emotions. And human emotions have a huge impact on valuation, particularly in speculative manias. And I would argue that we're in one of the three great speculative manias this past century. And so we're experiencing it right now with a lot of these hot new stocks coming into the marketplace. And the disinflationary period, we've just gone through recently 40 years of disinflation, a very lengthy period. So almost all of us know how to invest in a disinflationary environment. That's what we've experienced almost all of our investment careers. But we've only had an inflationary experience the last 5 years. Now, I've been working since '83, and I missed the big inflationary period. So even myself, I haven't truly operated in an inflationary environment. But the last 10 years of that disinflationary environment, we got to record low interest rates. And in that period, growth became explosively valued because the denominator, as interest rates got smaller, the future value of cash flows grew dramatically. So obviously investors flooded into the growth style and stepped away from the value style. And you're seeing here the movement away from value, and it's still at dramatic lows. The allocation of value around the world appears to be about 6% today. So I call it the mother of all contrarian trades. Value managers tend to be contrarian. There's very little money in value. The average value shop out there today, if you ask them what their AUM is, it's less than half of their peak. And as Alex pointed out, we're a bit less because we're more deep value. We didn't migrate into quality at all. But it's been getting better, and I'm going to explain that to you. So this is the famous Fama French value versus growth data series. And how you read this is looking at the Shiller PE multiple. So the black line is showing you the 10-year relative return of the market. And when the black line is above 0, so that upper mountain there, that is value outperforming growth. And when you see the valleys below the 0 line, that is growth outperforming value. So the first takeaway you get from looking at this chart is that most of the time, value investing wins the game. So it's really interesting that almost no one is investing in value today. The allocation is 6%. And the other interesting observation I want to make is that if you take a look from 1941-42 all the way to 98-99, there's a 54-year period where in every 10-year time horizon, value style outperformed the growth style. So there wasn't quality managers back then. They called themselves GARP, growth at a reasonable price, because no one would buy growth because for 54 years it didn't outperform. And so you had to add a little bit of, growth to value to your growth style. Today, value managers have been underperforming for a long time. So what have they been doing? A lot of them have migrated into quality. They're adding a little bit of growth in order to keep up with the market overall. And a lot of former GARP managers became quality managers overall. Now, to understand this chart better, I added vertical lines. And so you don't normally see this in a Fama French data series. And I think that the way to understand what's going on in the marketplace, it's very additive to know whether you're in an inflationary environment or a disinflationary market environment. And they tend to be lengthy periods. So are you in a falling interest rate environment or in a rising interest rate environment? And I think this picture comes into focus a little bit more. So although we see 80% of the time value outperforms, we see that there's this barbell effect where growth outperforms, on the two ends. And what's going on there? Why those two ends? Why did growth win then? And those were disinflationary periods, and not just disinflationary, but deep disinflationary periods, relatively speaking. And that's when growth has its chance to outperform. And each dot on that line represents a 10-year time horizon. And so we had, I'm going to call the low in rates, happened in the summer of 2020. And from that moment on, we hit the lows and we entered an inflationary environment. And my question to the audience is, how long do you suppose an inflationary environment is likely to last? And for a lot of observers, you hear people thinking that we're going to go back to a growth environment. They're actually wishful of it overall. So I'll come back to that, answering that question a little bit further along. So now that we're in an inflationary environment, how does value do in an inflationary environment? And Professor Georg Athanasakis in Canada took the famous FAMA French data series over a century. It's a century now. The first data series is 1926. And he said, how did value do versus growth when inflation was north of just 2.5%? And he chose that number because basically developed nations around the world are saying, we're going to inflation target 2%. We're going to try and keep inflation at 2%. So if they slip just a little bit, how might value do? And what he concluded in the end was that in that century of data, that value outperformed growth by 11% annualized when inflation was moderate overall. How has value done versus growth? And on the left-hand side is Canada, and on the right-hand side is the international market without the US, because we all know what's happening in the US market. It's the big, broad market. It's 70% of the world index. People pay attention to what's going on there. The Magnificent Seven is really covering over what's happening below the surface. And in these two markets, we have here, the left is Canada, and then international. And the very top line on both, or pretty much the top line, is the value index, and the bottom line in both those charts is the growth index. So value has been outperforming growth significantly, and shockingly, in my opinion, I didn't expect to see this, when you look at the value index versus the growth index and you do quick math, the result is 11% outperformance, just like Professor Georg Athanasakis calculated. That's kind of, not often you hit it on the head like that overall. So that it is working when you don't have the Magnificent Seven covering up what's happening below the surface. This next slide is showing you what's happening in the US. And you can see that 60% of value stocks in the US are outperforming. So value is working in the US, and only 40% of growth stocks are outperforming. But it's that tail risk, that far right-hand side of the chart where the Magnificent Seven are, and they're making the growth story look like it's winning. So we've got this subset that's doing extremely well. And so the big question is, when does that come down? Because the underlying story is the typical story that's happening in an inflationary environment. So how long should we guess that an inflationary environment will last in the marketplace overall? And we're going back in history here, and you can see that from the far left-hand side, you had the American Civil War, and then after that, inflation comes off after a war is over. And post-war, you tend to get them longer, so it took about 30 years for interest rates and inflation to bottom. And then you go to what I would call the more normal, typical cycle of 20 years. So 20 years of inflation, then 20 years of disinflation. And then after 1941, which was Pearl Harbor, America entered the war, and the next year inflation was 9.5%. And then you entered an inflationary period that lasted a remarkable 40 years. And they tend to be symmetrical, these inflation and disinflation cycles. I wouldn't hold anything to that, but there is this bit of a tendency there. And so then you have, it got followed by a 39.5-year, let's call it a 40-year disinflationary cycle. And so far we've been in a 5.5-year inflationary cycle. And because disinflation was so wonderful for consumers and helped them pay off their debts so nicely, especially heavily indebted American consumers, there's no surprise that the market is wishing for to go back to disinflation. But the reality is we haven't seen in history a shorter than 20-year cycle, roughly. So more than likely, we have another 15 years of an inflationary cycle to face. And in particular, this I call a very disturbing chart by Torsten Slok at Apollo. He gives away his daily charts for free, so you can easily access this yourself. And he's comparing and inflation, when you go back historically, it tends to come in waves. And he's lined up the 65 to 82 stagflationary period, which some people are arguing we have entered a stagflationary period. And it's remarkably similar. And you can see we're at a very critical point, as they were back then, where you have to play your cards very carefully not to go into a major inflationary spike. And yet you have an American president, similar to Nixon in 1974. Nixon put pressure on his central banker to drop interest rates because he was facing a re-election. And the central banker did comply and died on his deathbed saying, that was the biggest mistake I ever made in my life. So every central banker knows this history and knows they want to avoid it because runaway inflation is very difficult to suppress overall. So what happened in a stagflationary environment? And so this is the famous 65 to 82 time period. And it ended up being a sideways market where basically the market ended where it began. And you had a lot of volatility in between. And every time the market went down dramatically, you can imagine that would have been great for value managers. We would have picked up a lot of return as the growth guys got killed. And then every time the market went back up, you could have imagined that would have been really good for a growth manager because that's when their stocks would have done extremely well. And you would think that the end of that time period, that there was a tie between value and growth, but there wasn't. The total return was below historical averages, just under 6%, but the return for value was 13.5% overall. So it was a great opportunity for value to win. And what we've seen so far in this sideways market where you can see value doing well, not being hidden by the Magnificent Seven. And then just showing you, you break down the market into quintiles, and you can see that in that time period, the cheapest quintile, the cheapest stocks, the most value of the value stocks, when you have your best cheap characteristics, that should do really, really well. Then they did do very well. But we suggest you have to be very careful in this environment because there's a number of managers out there that have deeply gone the other way into quality overall. So why don't I believe that's the end of my slide deck, and pass it on to the next speaker.
Well, I'm not going to talk to you about value. Sorry. I'm going to talk to you a bit about what's going on elsewhere. The US market is, as Kim was saying, a very high share of the MSCI world market. As Georg was telling you, the US market is extremely concentrated today. And it's concentrated in the theme of artificial intelligence. Goldman, at the end of April, estimated that 45% of the US market is AI-related theme. This is not just a US market story. The emerging markets now are increasingly tied up with the AI theme. You take TSMC's, Samsung, and SK Hynix. And the computer hardware, semiconductors, as a share of emerging markets have gone from something like 23 to 43% of emerging over the last year, or at least until the semiconductor sell-off a few days ago. So really, if you're not buying value, you're buying something else. You're buying into the AI story. And what I'm going to talk to you briefly about now is how markets have responded to earlier new technologies over the past 200 years. And what I'm going to show you is that there's a common pattern at the inception of groundbreaking new technologies that doesn't really change that much. I wrote a paper earlier this year with my former boss, Jeremy Grantham, from which this presentation is taken. So you can find that on the GMO website. I also recommend a book by the former head of research at Templeton called Alistair Nairn, and it's a book called Engines That Move Markets. It came out in 2003, and I find it a very useful way of looking at looking at this history. And I wrote a history of financial speculation called Devil Take the Hindmost, came out in 1999, which I'm currently updating. Anyhow, so let's cut to the chase. So how does it start? Well, what happens is there is an emergence of a new technology that attracts excitement. And as Bill Bernstein, the author of a book called The Delusions of Crowds, that came out a few years ago, says that narratives are the pathogens that spread the bubble disease throughout a society. It helps that the new technologies, railways in the 19th century and telegraphs in the 19th century, telephones and wireless in the 1920s, and the internet in the 1990s, both serve as the object of speculations and the medium for spreading the speculative further. So what do we have today? We have the greatest technological narrative that has ever appeared. I repeat that, the greatest, most extreme narrative. Well, bigger than the invention of the steam engine, more significant than the invention of fire. A technology that within a short period of time will be forging the scientific breakthroughs that only Nobel Prize winners can achieve, that will be rewriting the works of Shakespeare, that will be driving GDP growth so that it doubles every few years, so that none of us will ever need to work again. A new era for humanity. Look, I read the history of financial manias. I've read what happens with the excitement that attracted to the railway when they came out in the 1840s. They talked about world unification, peace. Exactly the same language was used about the telephones, and likewise about the radio. Nikola Tesla thought that with the radio, the world would come together and operate with one mind. Many of you here will remember similar types of stories told about the internet during the internet boom. I'm not saying that these technologies didn't transform the world. They clearly did. But they came against, at the outset, a frenzied attraction. And here the chart shows this conception that we are on the verge of singularity, where the machine intelligence exceeds that of mankind. Again, normally in the history of technological financial manias, they normally occur against the background of easy money. This chart shows you the interest rates in the 1840s that went down to 2%, just as the great railway mania of Britain was taking off. And it was the great English financial writer Walter Bagehot who constantly went on about the fact that when interest rates fell to 2%, investors would do crazy things. Now, we clearly saw that in the late 1990s, beginning of the Greenspan put, if you remember, after the LTCM fiasco. We saw it in the early 2000s during the credit boom when interest rates were taken down. And we saw it in spades in the last decades and the first part of this decade with interest rates kept at zero and trillions of dollars of quantitative easing. Now, interest rates have risen since 2022, but there was a great deal of liquidity that remained in the system from the long period of quantitative easing, and monetary conditions, as you can see from this chart, which just shows US bank credit growth, have remained relatively loose. The essence of a mania obviously lies in general investor enthusiasm or optimism. And here I show you a picture of a satirical print of John Law's Mississippi bubble of 1720, of a frenzied crowd in the Rue Quincampoix, which is the open-air market in Paris, where stocks were traded. We find whole communities suddenly fix their minds upon one object and go mad in its pursuit, wrote Charles Mackay in Extraordinary Popular Delusions and the Madness of Crowds, 1841. A couple of years later, Mackay was actually buying railway stocks, which turned out to be a bad bet. But these compelling narratives corrode the analytical process, and dissonant voices are met with, dissonant voices are ignored, and skeptics are met with vehement criticism. Their warnings attract scorn and ridicule. What about today? So today, I am saying, is the most speculative market we have seen at any time in history. It is so speculative that we are numbed to how speculative it is. We live in a world of virtual assets, of assets not supported by anything, of which cryptocurrencies are the very essence. But we live in a world, and here the chart shows you the average trading, high turnover of retail cash in the US stock market. We live in a world in which, particularly in the US, in which retail investors are playing a dominant role. The world of zero commission trading, the world of Robinhood, of the Robinhood app. Robinhood is again, I don't want to use hyperbole the whole time, but it is a tool for gaming and speculation that attracts tens of millions of investors. We have a proliferation of ETFs. There are more ETFs than stocks nowadays. Many of these ETFs are leveraged. You can get 2 times NVIDIA, single stock, leveraged ETFs. You can get strategy, leveraged ETFs. Most of the trading on in stock options today is in single-day stock options, 60% of turnover. New York Stock Exchange margin debt is at a record high. I won't go on, because I could go on about that all day. Another feature of the boom is a wave of new publications promoting the merits of a new technology. In the railway boom of the 1840s, new railway papers were appearing every week. Many of them published twice a week, some published daily. The Economist and the Times of London added extensive railway supplements to their journals. At the end of the 19th century, there was a plethora of publications about motorcar technologies. You'll remember, some of you remember, the publications that accompanied the internet boom of the 1990s. Here I show you the cover of one, Industry Standard, that I used to write an occasional column for. Didn't live long. But there were a number of others, Wired, Fast Company, that sort of thing. Today, we don't really need magazines. There are online magazines like The Information that writes daily about AI, and actually is very high quality analysis of what's going on. We are wherever you look, there is AI. There's AI, obviously, on the social networks, on X, on TikTok. There are AI podcasts. The AI dominates. It dominates the Google search terms. There is a preprint academic online portal called Archive. Apparently, it publishes 100 papers a day on AI. No doubt many of those papers are written, in fact, by AI. There is no shortage. We are drowning in information. Very important feature of the boom is an efficient and productive supply machine capable of creating a host of new companies to meet investor demand. A shorter way of saying that is the Wall Street adage, when the ducks quack, feed them. In 1720, during the South Sea bubble, 200 companies sprung up, the so-called bubble companies, of which the most notorious was a company of great advantage, but no one to know what it is. Of those bubble companies, two bubble companies survived. During the railway mania, there were hundreds of railway companies that were launched. Again, going back, I highlight here the IPOs of 2000. You see there, and then the SPAC, the notorious SPAC boom of 2020-21. But as I say, we're doing things bigger and better today. There's a Goldman's chart recently showing the expected IPO proceeds in the pipeline this year. three companies, SpaceX, Anthropic, and OpenAI, if OpenAI actually gets to market, which is a big question mark, would actually account for raising more capital than the entire TMT boom. And those of us who lived through the TMT boom and got those, these endless, brokers, bloated brokers, IPO prospectuses with the most intolerable nonsense in them, can hardly believe that we have come back to see the same again. And as Alex was telling you about SpaceX, a company that's going to transform humanity, to conquer the universe for mankind. I mean, it is not just the most overvalued. If one can't even really talk about valuation, a loss-making business with a 1.75 trillion valuation, raising a record amount of capital. But it's not really just in the IPOs. So, quietly, Google slipped out, or Alphabet slipped out, 84 billion or 85 billion secondary issuance. And in case you didn't notice, earlier in the year, Google was issuing, or Alphabet was issuing 100-year bonds. So it's raised another 80 billion from the debt capital markets. And if you look at this chart from Torsten's Lok of Apollo, I had the earlier part of this presentation, which I was showing last year, sort of earlier version, and it had venture capital share of AI at 67% last year, which seemed high to me, except Slok's updated it, says that venture capital is now 87% of AI. And AI is now nearly 50% of investment-grade debt issuance. I understand that this year, every month this year, has been a record level of investment-grade debt issuance, of which driven by the increasing share of AI in the debt issuance, and high yield down at a measly 38% AI exposure. And that's not all, because the entire structure of modern finance has come to push the AI theme. And so we have SPVs being used to finance the data centers and private credit and so forth. The suspension of normal and other suspension of normal valuation criteria. I showed you this chart, which was stolen from the presentation, the paper that I did with Jeremy earlier in the year. Fair enough. And what we, I think my former Urban and my former colleague Ben Inker showed that when the stocks that trade on over 10 times sales deliver, I think, something like 2% returns, so sort of roughly less than a third of the average market level. But here you have, and then more commonly people use the cyclically adjusted price earnings ratio, which went average just under 18 times since 1880. Peaked at roughly 33 times in 1929, 44 times in early 2000, and around 40 times when I last looked. But I want you to stick with the price to sales ratio here, and that's for the whole market, not just the share trading at 10 times sale. So you see on this measure, the price to sales ratio of the US market is at its highest level ever, exceeding the everything bubble period of 2020-21, and far exceeding the dot-com peak of 99-2000. And why I think this measure is most important is that US profits are currently highly inflated or bloated. And what that means is that we're having a high valuation of the market on top of high reported profitability, which is what my old boss Jeremy Grantham calls barbaric double counting, because in an efficient market, we should have a low multiple on high profits and a high multiple on low profits. I think one of the things that distinguishes the bubble today, and Georg and I were talking about it last night when he said, you know, these stocks are not, some of these big stocks are not that expensive. They're not optically expensive on a price-earnings ratio, not optically very expensive on a price-earnings ratio, but the profit margins today are much higher than they were in 2000. You see, and that's clearly the case. You see what's happened, say, to the semiconductor stocks, which have profits now up in sort of 80 to 90% range from, you know, which is something, let's say, something like 4 times their average range. So this is I like to call it a fundamental bubble as much as it is a valuation bubble. It is not always the case, but sometimes the case that when the technology arrives, it's not quite mature. And I'm showing you here is a picture of the carbon arc lamps technology that came in the early 1880s, attracted a lot of attention, but the trouble was they worked, they were going to be used for public lighting, but they were expensive. They were more expensive than gas lighting, and they were later superseded by Edison's incandescent light bulb. And although Edison was a critic of the carbon arc lamps, he hadn't actually developed the technology to get his incandescent light bulbs to work at the time. Now, I'm saying this is not always a feature of the inception of the new bubble, but it is often the feature. The other thing we should say about the inception of new technology, it's not clear always clear which technology is going to win. For instance, in the 1990s, with the new automobiles, there were steam engine technology, steamers, electric, supported by Edison, and the internal combustion engine. Well, electric and steamers far outsold internal combustion engine in the 1990s. I think the first stock to list, automobile stock to list in the States, was an electric vehicle. It turned out the electric vehicles didn't have range and were expensive. So exact same problems they have today. Now, I'm going to maintain, and this gets a bit contentious, that the large language models are an immature technology. They are questions about, I'm not saying that they aren't marvelous, but there are questions about their reliability to the nth degree. And the question of whether the hallucinations, the tendency to come up with wrong answers to bullshit, is an inherent part of the technology. I don't know. But what I do know is if you keep an eye out, despite the great advances that are going on almost on a monthly basis with the frontier models, they are still hallucinating. Just read the newspapers closely. You will see stories. I mean, the other day, Sullivan and Cromwell, large top US corporate law firm, had to apologize to a US bankruptcy judge for including in its filings hallucinated material from some intern who no doubt got the sack. So you've got the Claude codex, the advance in vibe coding, there was a story a month or so ago of a company that provided software for car rental companies, which used vibe coding, used the latest Claude model, and it wiped out its entire customer database. So I'm going to suggest, well, Amazon, I mean, I don't know, Amazon took down its own Amazon Web Services after some of its guys had been vibe coding. So I'm saying there's a question mark that remains over this technology. There are little bugs that remain that have to be ironed out. And that's just part of the story. We don't know what type of artificial intelligence model will predominate. Will they be these frontier models run on the giant, in these giant data centers, incredibly capital intensive, energy intensive business? Will they be more the open source model? Turns out to be a lot cheaper that the Chinese are offering. Or will they be these small language models that can actually run on Apple computers and may be running on your phone? I don't know. Nobody knows. But we're making very big bets as if we do know. A huge overcommitment of capital forcing down potential rates of return. On the left-hand side, you see the British Railway capital invested in the in railways. The first railway came out actually in Britain in 1825. Little sort of boom of investment in the mid-1830s, and then a huge surge of investment in the 1840s. And this is really the greatest investment boom relative to GDP that ever happened. There were, I think by 1847, 7% of GDP was being directed into investment in new railway stock. And there you see the movement of the share price, which follows, well, it actually precedes the investment boom. And the upshot of that was massive overinvestment in railways. So I like to say there were 3 railway lines running between London and Peterborough in East Anglia, 3 railway lines running between Leeds and Manchester. And I saw the other day that actually if you'd invest, the transportation technology knocked out by the railways was obviously the canals. But if you'd invested in canals in 1845 and held your canal investments till 1850, you'd have made money, or at least not have lost as much money as the 65% fall in the UK, the British railway market. And that here you see the TMT investment, the sort of Tobin's Q relative to the US investment to GDP. If you remember, massive over-investment in fiber optic cables, which I think, say, in the range of overcapacity, ending up about 95 to 98%. And what's interesting about that one, I can't go on too long, is that there's a guy called Andrew Odzliko who was working at Bell Labs at the time, who pointed out that the market narrative of data traffic doubling every 2 months was false, that data traffic was only doubling once every 6 months, and the upshot was that over the course of the year, that's a 12-fold exaggeration. We could have told, or we knew, if anyone cared to pay attention, that the narrative of growth that was driving the investment was false. Today, capital spending in AI is going hyperbolic, and it just keeps on, you can't make a presentation on AI because you have to redo everything every few weeks because everything gets bigger and bigger. So this is Gerard Minack, who used to be the strategist at Morgan Stanley, and he shows it there, the sell-side forecast for the hyperscalers investment from July of last year at sort of 450 million, going out to 27, and then jumping up this year, updated to over 900 billion. And I think JP Morgan has an estimate for next year of 1.3 trillion of AI investment. And that's just the listed companies. And the perception among the players is, and this is put by Mark Zuckerberg at Meta, is that it doesn't matter if we lose a couple of 100 billion on this investment, or as the Alphabet CEO said, the risk of underinvesting is dramatically greater than the risk of overinvesting. And I used to think that they were really caught in a prisoner's dilemma, where one person was moving, others had to follow. But now I actually think that there is this theory of mimetic desire from the French social theorist René Girard, in which human beings are wired to imitate and copy each other. And I think in Silicon Valley, that highly competitive place, mimetic desire may be driving this investment as much, if not more so, than actually a prisoner's dilemma. They all want to be the first to get to AGI. They don't want to fail. And if they take down their companies, they're not going to take down their companies. But even if they were to take down their companies, it'd be a small price to pay. Unscrupulous and fraudulent behavior, what J.K. Galbraith called the bezel, the inventory of embezzlement within the financial system. A bubble, the original meaning of the word bubble, is a fraud. That's what the South Sea bubble was. It's the South Sea fraud. Every single bubble contains a large element of fraud. Where is the AI bezel today? I can't tell you for sure, because the bezel only becomes clear after the bust. That's its nature. But I think we can see the outlines of it in the sort of house of cards of commitments of capital flowing from businesses in the AI environment, in which there are now, I think, again, it sounds like a large number, but I read it again this morning. There are $1.5 trillion of pre-commitments off balance sheet in the AI universe. And there is this vendor financing in which companies are, like NVIDIA at the core, or the hyperscalers are lending money, or the hyperscalers investing in the frontier model makers and generating profits from these investments, which, as we saw in the with the telecoms equipment makers in the 1990s, didn't pay off. There's also a problem with the depreciation rates used on the GPUs. They've extended them from, in general, hyperscalers from 3 years ago to 5.5 years today, and CoreWeave is out at 16 years apparently on its GPUs, while heavily selling insiders' stock. Eventually, you get to the shakeout, and the point about the shakeout, I think there are severe shakeouts whenever there are high amounts of competition among new technology. I think the only exception I can find, to my recall, is that because I think that the Bell telephone system had pretty good patents and pretty good monopoly, and therefore was able to establish itself without a huge shakeout. But in general, the new technology, a large number of competitive players, in which one or two will emerge dominant. This is clearly, there is no doubt about it, this is clearly an intensely competitive market, and I think very unlikely that there will be, I put it differently, very, very likely there'll be a severe shakeout. And if you want to invest in this stuff, by and large, the time to invest is in the during the shakeout phase rather than today. So what can we see today? The capital investing entering the AI space exceeds TMT, investment turn a century. The risks elevated by growing amounts of debt. Question marks remain about the large language models. Based on past precedents, from the railway mania onwards, this certainly looks, to my mind, like a bubble. As I said, nearly half the market, US market exposed, and that makes for sort of roughly 1/3 of the MSCI ACWI market. US stock market, by many valuations, most expensive in history. This time, may be different. Never is.